In this video, we'll be discussing Chapter 14, Section 2, Federal Taxes. The question being asked is, what taxes does the federal government collect? At this pie chart, you can see the majority of taxes that are collected each year on the federal level. You would find that the income tax is by far the greatest amount of income that they can get, or the greatest amount of taxes that are collected is the income tax. And then Social Security, Medicare, and unemployment is second, and then so on and so forth. So the income tax is a big provider of revenue for the federal government. Now, there is individual income taxes. The government could decide that at the end of the year that you would write an entire check for income tax that you owe for the year. But the problem is, it would probably be difficult for most Americans to be able to, one, have the discipline to do this, but second, be organized enough to sit down and figure out how much taxes needs to be set aside each paycheck. So what they do is they pay as you earn taxation, meaning that every paycheck that you get, there's taxes taken out that are given directly to the government. These are designed to pay current debts, pay employees, such as all public workers. This would be your senators, House of Reps, all their staff. This would be the president. Pays employees, supplies, everything that's involved on a day-to-day basis that needs to be paid. And then we have something called an individual income tax. So when you get that future job, even if it's a part-time job, you are put into a tax bracket. And as you can see here, there's a Schedule X and Schedule Y. And there's more of these, and these are updated from year to year, but we're going to use this bracket that we see here. So in Schedule X, it talks about filing status as a single individual. If you make anywhere from $0 to $8,025, you are in the 10% tax bracket. If you make more than $8,025, you are now in the plus 15%. And then as you can see, the more money you make, the higher the rate of income tax is taken out. So the whole idea is that the burden is carried more by those who make more. Now, when that money is taken out for taxes, it is called a tax withholding. And then your employer, if you have a part-time job right now, your employer's job is to collect these taxes they've been paying you, and then they will be turning in this amount from all their employees on an installment plan. All an installment plan is just a schedule of when the employer is supposed to turn in these gathered taxes to the federal government. Now, at the end of the year, if you have a job right now, you will be getting a W-2 form. And this W-2 form is designed to see how much money that you made throughout the year. So it'll have like your Social Security number on there. It'll have your address on there. It will have all of your income taxes taken out, your federal taxes, your state taxes. I mean, everything is on this document. And this is not something that you just look at and throw away. You actually hold on to this for nearly a decade when you file your taxes, because the government could always audit and go back and check. So a W-2 form is now the form that you use to file your taxes. On that form, you will find something called a taxable income. This is where your money that you have made minus any exemptions and deductions, and we will discuss what that is in a minute here. So you will either get a W-2 form or a 1099. A 1099 form, if you ever have an employer that says, we will give you at a 1099 at the end of the year, this is what it means. It means that they are not responsible to take out the taxes from your paycheck. That is up to you. It is your job to make sure that you are keeping enough taxes from your paychecks in order to pay this at the end of the year. W-2, the employer collects the taxes for you. 1099, the employer does not. It is your responsibility. Now, there's something called a personal exemption. Personal exemptions is a amount of money that is deducted from your taxable income. When we file taxes, we will refer back to these terms to better understand how these work. So for every member that lives in the house, you get one exemption. So if it is your parents, and let's say you have one other sibling, that means there will be 4 exemptions coming from your house. Unfortunately, pets are not included in this. And if grandma or grandpa lives with you guys and they no longer have an income, they could also be included into this. So anyone who's a dependent. So when you go to college, and if you still live at home, you are probably still considered a dependent, meaning you're relying on your parents. That means they can claim you at tax time. But if you move out of your parents' house and you no longer depend on them, well, you're considered an independent, and now you're on your own for filing taxes. The other thing is a tax deduction. This is just a number that is out there to continue to get that taxable income down to 0 as much as possible. When you're filing taxes, you're trying to get what you make throughout the year to that bottom bracket. If we were to go back quickly, you would see that in the tax bracket, you want the lower amount of income you make, the lower amount of taxes they're going to collect. So you try to deduct your exemptions, your tax deductions, and try to get it as low as possible. And by doing that, that means it's going to be a lower percentage of your taxes or money need to be paid. Other things that you can claim for your tax return, you can do a tax credit. So when you start accumulating interest on your student loans and you start paying back your student loans, you will get a tax credit for this. So again, you can get that taxable income down. Other things a tax credit would be childcare, higher education like your college, your books for tuition, healthcare costs. A lot of this you can receive tax credits on. Now, the due date for your taxes. Now, obviously you don't wait to the last day, but the due date for it is April 15th. If you have paid too much taxes throughout the year, you are given a refund. If you do not pay enough taxes throughout the year, you make a payment. That's all a tax return does. Did you pay enough taxes? Okay, you paid too much, you get a refund. You paid too little, you make a payment. But you must get it in by April 15th. If April 15th falls on a Saturday or Sunday, well, then the date is not. If it's April 15th on a Saturday, well, then you have Monday, the 17th to get it in. Or unless it's a holiday, it would be the next day. All right, just as personal individuals have income taxes, personal income taxes, corporations have the same thing. These numbers are no longer accurate since in the last couple years, the income tax has changed. So just as you are trying to get your taxable income to 0 as much as possible, corporations are doing the same thing. So if you ever work for a corporation and they say, they're sending you on a business trip and they say, hold on to all your taxes. We can use those, or all of your receipts. We can use those for taxable purposes. What that means is they can deduct your hotel stay, your car rental, your food expense, anything and everything that is included in here can be deducted. If your job is sales and you take out the client for a dinner or whatever it is, that is all tax deductible. But if you do not hold on to those receipts, it may be in the corporation that you work for, their protocol that you will not get reimbursed because you were not responsible enough to hold on the receipt. Other taxes that are taken out, we have FICA, which is your Social Security, Medicare, and unemployment taxes. These are all taken out as well. So Social Security, Medicare, and unemployment tax. And then other taxes known as an excise tax. It's basically a tax for whatever they want. They could throw an excise tax on gasoline for a year to help pay for things. Usually excise tax can be tacked on to things especially that are harmful to us or considered a luxury. Harmful cigarettes, e-cigs, alcohol, cable television is a luxury, buying a brand new boat is a luxury, so they can have additional taxes. If you go on vacation somewhere, they're going to have additional taxes as well. Now, there are other taxes such as an estate tax. This is where if, let's say, grandma and grandpa passed away and in their will, they have left you their house. Well, just because they passed away doesn't mean that you don't have to pay taxes on it. Even though if the house is paid off and grandma and grandpa have paid taxes on it, you are getting taxed on this estate. It is known as estate tax. So really that property, that house, is getting taxed twice. Grandma and grandpa paid for it, and now you're paying for it because it's considered a large amount of income, so they're going to have you pay tax on it. So what individuals were doing is that grandma and grandpa were giving away all of their stuff prior to passing away to avoid the estate tax. So now there's something called a gift tax. So if grandma writes you a check for, the rate today is now $15,000. It has been boosted since 12. Let's say grandma and grandpa want to help pay for your tuition, and tuition is $40,000 a year. If they give you a $40,000 check, you would have to pay taxes on that, even though it's for, actually, I apologize. If there are certain exemptions. So paying for college, I believe, is an exemption for that, so you wouldn't have to pay. Or let's say they go out and buy you a brand new car with this. They give you a check for $40,000, you buy a brand new vehicle. This would consider to be in the category of a gift tax. So anything above $15,000, so let's say it's 40, we deduct 15, so that $25,000 would be considered part of the gift tax, and you would have to pay, or your grandparents would have to pay a tax on this. Import tax, tax on imported goods. So the products that are imported into the United States, they have something called a tariff on it, which is a tax. So right now we have a trade war going on with China. It is because the U.S. has raised taxes on Chinese products that are coming into the United States, known as a tariff. Well, then China has done the same thing with U.S. products going into China. So whenever they talk about raising tariffs, it's talking about raising taxes on imported goods. So if you wanted to buy a vehicle or something rather expensive or a piece of equipment outside the U.S. and it comes into the U.S., they would have a tariff on top of that. Tax incentive. This is the encouragement of or discouragement of certain types of behaviors. Remember we mentioned the excise tax? Well, this can also be a tax incentive. A few years ago now, if you bought an electric vehicle or a hybrid vehicle, there was a tax incentive to do that because the government would give you a tax credit for that vehicle. Now, with the push right now with e-cigs are becoming or are already harmful, but since they are an easy target right now for stating that they're very harmful, you can put a tax on e-cigarettes and the refills and cartridges or whatever comes with them, which will then hopefully discourage individuals from buying that product, which would change behavior. So they can be a positive or a negative when it comes to tax incentives. And that is the end of this section of Chapter 14, Section 2. And we discussed about federal taxes and what they use for different taxes to collect revenue.